The public hearing today is conducted via video conferencing, and participants join us and can join us from different time zones worldwide. So we would like to welcome you, all of you again, and we really appreciate your interest and keenness to join us in this event. Today's session is being conducted with support from three prominent banking associations across the region, namely United Arab Emirates Banks Federation, UBF, Participation Banks Association of Turkey, PKBB, and Bahrain Association of Banks, BAB. So here we would like to extend a word of thanks and appreciation to all these associations for taking part in this, or really taking an active part in today's session. Ladies and gentlemen, distinguished guests and dear brothers and sisters, I'm pleased to invite to the virtual floor Mr. Omar Mustafa Ansari, IOFI Secretary General, to present the exposure draft and walk you through its main content while interactively answering your questions and addressing your comments. All relevant comments and suggestions will be collected and presented to the respective working group to consider and make the changes it deems appropriate to the exposure draft before submission and after completion of all legs of public hearings to IOFI Accounting Board for its further review and issuance of the final standard. Mr. Omar Mustafa Al-Ansari, over to you.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Ladies and gentlemen, distinguished guests, scholars, and experts, Assalamu alaikum wa rahmatullahi wa barakatuh. Very good morning, good afternoon, good evening to all of you, depending on the places of the earth from where you are joining us. This standard, as a standard, is very close to my heart, and that is because here we are talking about the real essence of Islamic finance. We all understand that Islamic banking and finance works in a dual banking system model or dual financial system model, which is primarily dominated by the conventional financial institutions. And we all well understand that the conventional financial system, which is primarily based on interest, has some of its intrinsic and inherent evils, because of which riba has been prohibited. So when we talk about Islamic finance and banking working in this system and trying to carving out a way for Sharia compliance, so while we fully understand that any product of Islamic finance which is in accordance with Sharia principles and rules, particularly the IOFI Sharia standards, that should be considered permissible and halal. But it's not always the ideal. We all fully understand that Islamic finance includes some of the products which are just as a replacement of conventional finance, have reached the minimum level of Sharia compliance. There are some products which are generally good, but may still have some of the elements of, I won't say compromises on Sharia compliance, but I would say that they may still have less than preferred approach towards the Sharia compliance and the essence of the transaction. But there are some products which are not only the ideal or close to ideal products, but also are the real backbone of an Islamic economic and financial system. And the same have been practiced for a long time, maybe nearly 1400 years. We have been evidencing in the Muslim world, and And a lot of people ask, when there were no banks, how financial system in Muslim worlds used to work. So what I'm talking about is not intended to undermine the Sharia compliance of the other products, but we also need to understand that what is the essence and spirit of Islamic finance that primarily comes through the participatory ventures, that is primarily Musharaka and Mudarba. Considering Islamic finance and banking in the current times, we know that the core of Islamic finance on the liability side is mainly built on the Mudarba-based model. Last couple of years, we have finalized our updated standards on investment accounts, including on-balance sheet and off-balance sheet accounts. We have discussed the issues of controls. We have discussed the issues of internal transfers between the pools. All these standards are finalized. But that is on the liability, or as we call quasi-equity side of the Islamic financial institutions. The asset side of Islamic financial institutions is still at this stage very raw, very less practiced, and to some extent feared by a lot of bankers. One of the main reasons is that if I'm a banker and I can find a solution in Islamic finance that gives me exactly the same results and same risk profile and same regulatory compliance and the same capital adequacy maintenance and the same minimum capital requirements and all that, I would always prefer that product. And that is what has happened to Islamic finance, that a lot of products that we are using are, although being Sharia compliant and having their own strengths and intrinsic values, which are according to Sharia, and still, I would say that even worse of these products would still be better than the conventional, because irrespective of the similarities, these are Sharia compliant. But because of that banking mindset or the finance mindset that we have, we try to go into the same direction in which the conventional institutions are going. And from that perspective, we just try to replicate and mimic the products, because that gives us a sort of confidence that we are within the known regimes. We are within the already explored waters. We are not going into something which can be like, a very risky thing or something. On the other hand, in the initial days of Islamic finance, we can note in certain countries there were some incidences of failures of Musharaka and Mudarba-based projects because of lack of governance, because of lack of appropriate accounting and financial reporting, because of not having a proper portfolio, because of not having appropriate exit strategies in line with Sharia principles and rules, because of general market practices which may not be, like the society may not be very well prepared for it. So after a few failures or deemed failures or some bad experiences, our banking fraternity, Islamic finance and banking fraternity, by default decided that, okay, we will have angels, then we will have Musharaka. I've heard people saying this thing, that Musharaka and Mudarba can work in a society only between angels. No, I'm sorry. If you close the doors for impermissible things and you don't develop yourself, the mimicking and replicating products, I can assure you that there are private markets where you can still work on Musharaka and Mudarba. I was having a training class some time back, and I said that there are different financial sectors. We have commercial banks, we have investment banks, we have venture capital and private equity firms, and we have stock market investors who at times do speculation as well. Just giving you an example that out of these categories, who normally earns the maximum of the profits and who normally earns the minimums of the profits? All of you may agree that the normal retail and commercial banks earn the minimum percentage of return on their investments and on their equity. Their return on equity is the minimal. More than them, investment banks get more than that. Their return on equity is much more whenever you try to calculate the numbers. Private equity and venture capital are generally even more profitable. And then, you have people like Warren Buffett, who just made money out of the fortunes were mainly coming from the stock market investments. And we are aware of so many people like that. Add crypto to that now. So the point is that risk and reward normally go side by side. If you go for low risk, normally the reward is also less. But then I asked that class, and actually I asked it multiple times, that what is the probability? Okay, let us try to put it as a poll. Sister Saira, can you help me in putting a poll on this thing? Please note down the wording. Are you noting? Please confirm.
Yes, brother, noting.
Okay. What is the probability that this is a question? What is the probability that a reasonably diversified portfolio of investments on Musharka and Mudarba basis will result in net losses over a reasonably long period of time? Can you repeat the question, please?
What is the probability that a reasonably diversified portfolio of investment on Mudarba and Musharka basis will result in net losses over a reasonably long period?
Just add something to that. If appropriate governance structures are in place, and an appropriate financial reporting framework is applied, and Sharia compliant exit strategies are in place. Okay, let's do this poll and see what is the answer. So now we will move to the standard. This background was important because we don't, as AOFI, we don't only believe that we need to develop a standard on products which are less practiced at this point of time in Islamic finance. Even if there is a little use or use in several countries only, we still are bound to develop the standards for the benefit of the industry But at the same time, we believe that we need to play our part in developing the industry on the right grounds. And we believe that developing this standard or updating this standard is one of the fundamental aspects of this mandate of AOFI. So let's move ahead with the standard, and then we come back. I think my screen sharing is stopped. Saira, have you?
No, it was my secret.
Okay. Okay. So Sarah, you can share the poll in between and we can just have a answer from everybody. So the question to everybody, I think it will be appearing as a poll now. Is it appearing or not?
Not yet, so.
Just another 5 minutes. Just need to access the place.
Okay. Then we are continuing with the standard and we'll have this poll in the ongoing basis. So now this standard is going to replace FAS 3 and FAS 4, which are our initial standards developed nearly 30 years back. So there was an appropriate need for appropriate revision, a need for appropriate revision of the standards in line with the newer practices in Islamic finance and banking, number one. Number two, in line with the alignment with the international financial reporting standards and the new AOFI framework, new AOFI FAS 1 and other standards as far as practicable. Number three, to address some of the missing points which were not covered in the last standard. Like, for example, the last standard was addressing mainly the asset side, but not the liability or quasi-equity side, and not the accounting and financial reporting by the venture itself. Similarly, the issue of accounting, subsequent measurement accounting particularly, was not very clear. The initial standards of AOFI included Sharia principles within that. Now, at that point of time, there were no AOFI Sharia standards. So some Sharia principles were written within the standard and some were attached as an appendix to the standard to clarify what is a proper musharaka or mudarba. All these things are now contained in the Sharia standards, and we have different mandates for our respective boards. So from that perspective, anything related to Sharia is no more included unless it has an accounting impact. Otherwise, all AOFI financial accounting standards are to be read in conjunction with the respective AOFI Sharia standard applicable on those products. This was an initial background. We decided to revise this project as a part of the financial accounting standards revision strategy and work that we did. That project was done several years back, but we identified the priorities, that some standards were on top priority, some others were on a comparatively low priority, not because that we did not want to prioritize them, but those who are aware about our standards, you might be aware that almost we have revised almost the whole book that was available several years back with regard to the financial accounting standards. So it is like some of the things went according to priority, and some of the things went according to the development stages of different projects. So some of the projects worked on a faster track. In a nutshell, when I say that it was appearing on a low priority, it did not mean that it was given or assigned low priority by us because we gave this standard or these products less priority, but more because there were more impending needs with regard to revision of certain other standards and development of certain newer standards, considering the changes in the financial markets and considering the changes that were coming from the IFRS side. We had to catch up with the IFRS as well. And I think that at this point of time, we have almost caught up with IFRS. IFRS 18 will be the new one. Other than that, till IFRS 17, we have developed equivalent standards wherever necessary, or other standards from IFRS. As you all know, we consider that they are fully applicable if they have no Sharia issue. So from that perspective, the certain projects that are in hand for us right now, including this one, Salam and Istasna, etc. Other than that, probably we are now almost matching with whatever has come up from IFRS. This standard will be read with the Sharia standards on Musharka and Mudarba. I have provided you the initial background up and some of the significant changes already. So we will be like, not repeating all of these things. I think there is one very important thing that we need to mention, that even the terminology, etc., has been aligned, and it was decided that even Phase 3 and Phase 4 were on Musharka and Mudarba, they were having a lot of similar treatments, because principally both of them are participatory ventures. Difference arises in how the profit is apportioned, or how the losses in case of commingling, etc., are applied. That is, again, in case of loss, according to it will be according to capital, but profit appropriation between the working partner and the partners in case of Musharka, etc. These are some of the things where the a limited accounting difference would be there. But let me be clarifying one thing. Distribution of profit according to the formula is a Sharia and contractual issue, not an accounting issue primarily. So even from that perspective, accounting wouldn't change. And that was the reason that we proposed internally to the accounting board and also to the working group and to the board, that if possible, we will be developing only one standard, because the purpose is not just to have a large number of standards, but rather we need to keep things aligned. So since most of the accounting requirements in both of these standards were similar, so we preferred that we keep it as a single standard. At this point of time, about the introduction or the initial comments that I made, if there are any questions, we will take that. I can't see anything coming in the Q&A tab. There are comments and some comments in the chat window. If anybody has put a question or a clarification request in the chat window, they are requested again to put everything in the Q&A tab. Normally, as you all are aware, that we request to provide questions in the Q&A tab only. Only rarely, if we have time and if we can manage time, only in those situations we try to make the mics available and the opportunity provided to speak up. But at this point of time, I think we are not sure about it. So we'll see towards the later half of the session today if we can manage time and allow people to speak. So at this stage, I still can't have any question. So I can't see any questions. So I think it's okay. Let's move ahead. Objective of the standard is to prescribe the principles of accounting and financial reporting for the participatory ventures. The scope of the standard includes all participatory ventures. For that, you need to see the definition in 4D, except for the exclusions provided in paragraph 3 in respect of accounting and financial reporting by the investor, working partner, and participatory ventures. Okay, let me put one question again, Sarah, if you can put it in the poll, but maybe that question should be towards the end in the poll, because I remember that the board and working group also wanted to have the view of the market with regard to combining the standards, because earlier standards were called Musharka and Mudarba. So even the name of the standard here was discussed in different ways. And then we decided that we are talking about Sharia compliant participatory ventures here. So it can be a single name. But even if we have any comments on the name of the standard and whether we should have one standard versus two standards, we would love to have comments on these parts. So maybe we don't necessarily need a poll on that. Just a request to all of you that if you can kindly provide your comments again in the Q&A tab with regard to whether you feel that combining the two in one standard is a better approach for a better alignment and managing similarities in accounting treatments, number one. Number two, is it more appropriate that we call it a participatory venture standard, or you want it to be called as Musharka and Mudarba standard? Okay. Now you all can see there is a poll number 2. Where is poll number 1 gone? Sarah, I don't know what happened to poll number 1. It is untitled poll number 2 that is appearing on my screen. Hopefully it would be appearing in everybody's screen. I cannot vote actually. Host and panelists cannot vote. so I cannot vote. What is the probability that a reasonably diversified portfolio of investment on Musharka and Mudarba and Musharka basis will result in net losses over a reasonably long period? If appropriate governance structures, Sarah, it should have been a comma. It should have been a comma before if. Anyway, it's okay. I think people can well understand, but it's a typo error. If appropriate governance structures are in place and an appropriate financial reporting framework, it's a financial is missing, Sarah. Reporting framework is applied and Sharia compliant exit strategies are in place. I think we are talking about all the three things being in place. So it's okay. I think everybody can understand the question irrespective of a couple of typo errors. So if we can just request all of you to start voting on this point. I just received a comment in the chat window that I cannot see the poll, please. I think poll would be appearing for everybody, but just make sure that it's available. So I'm continuing the discussion in the meanwhile, while you guys can just quickly answer the poll as well. This standard shall apply to, this standard shall not apply to the following: investment accounts and similar participatory instruments issued by Islamic banks. And it's now here, similar participatory instruments may be sukuk, musharaka and mudarba sukuk. Now, this is a question that if you are an Islamic financial institution and you are issuing a musharaka or mudarba sukuk, would you be applying this standard or would you be applying FAS 46? 45 or 46? 45. The second. Sarah, the footnote reference here, this is a wrong footnote reference. Incorrect. Brother Majd, can you make a note of it? Here we should refer to the quasi-equity and the quasi-equity and the other standards. It's not talking about
investment accounts and participating instruments, yes.
Okay, maybe it need reference to all of these. Maybe it need reference to all of these. So the footnote reference, please remind me to discuss. But the question will remain, the quick answer to that is, but I think we need to provide basis of conclusion and clarification. I remember there was some discussion on that part, that which of these standards will be applied. We have seen tier 1 and tier 2 equity instruments in form of sukuk, mudarba sukuk, which are sharing from the same investment pools. That is clarified in that standard that they will be subject to the requirements of that standard. But if I am a corporate entity and I issue a sukuk based on mudarba, my accounting will be subjected to FAS 29, which is an exposure draft stage, not yet final. So in the absence of FAS 29, generally FAS 1 covers the requirements, but not in detail like FAS 29. But the back-end accounting of the venture behind that will be done according to this one. This is a quick answer to the question that we had discussed in the working group and the board. But if you have any specific questions in this regard, we will appreciate to have those questions now or later in writing to make sure that we do not create any confusion on that part. The second part is that Wakala Ventures or the Wakala-based participatory instruments, which are the Wakala-based, the SMAR accounts and other products, including Wakala-based sukuk, they are subject to FAS 31 requirements, not this standard. Then co-owned assets based on Shirkatul Milk, as such assets do not constitute a participatory venture. This is a very important point. That in certain markets, a diminishing musharka product, generally what is called as diminishing musharka, is a shirkatul milk product, not a shirkatul aqd product. Those shirkatul milk products are normally coupled with a jara contract. So we say that if it is coupled with the JARA contract, then FAS 32 will apply. Otherwise, it will be presently excluded from the requirements of this standard because co-owned assets, even if you understand well, the co-owned assets accounting versus a venture accounting, even under IFRS, is different. So the co-owned asset accounting should be different, and this is where we have also, this is also another place where we have technically aligned with IFRS. Participant investment funds and other similar participatory instruments issued by Takaful institutions to Takaful participants which are subjected to the requirements of relevant UFI phases. These are the funds, including the risk sharing fund and the investment fund, PIF. Those funds are managed by the Takaful entity, but they are, particularly the participant investment fund, technically becomes a participatory venture as well. But since that is covered appropriately in FAS 42 and 43, so this standard will not apply. Now, investment structures in form of a legal entity, Brother Majd, this is where we need to give a FAS 14 reference. And the first one was not a FAS 14 reference, that was 45, 45 and 46 reference. Okay. Investment structures in the form of a legal entity, for example, those including issuance of share capital by the working partner, investment in sukuk shares and other similar instruments which are subjected to accounting in line with the requirement of relevant UFI phases, investment funds and entities having the status of legal entity which are subject to financial reporting in line with FAS 14 currently, but even FAS 14, as you are aware, is being revised, and the revised version is to be issued, inshallah, within this year. So these are different forms that these are also technically participatory ventures. So for example, I'm a working partner and you are an investor and I issue additional share capital to you. That goes in normal accounting and it will not be accounted separately because share capital has been issued. Investments in sukuk share on the other side will be subject to this one, except for the sukuk based on participatory ventures to the extent of underlying product or asset accounting as referred back to this standard by FAS 29. And the investment funds, which will be subject to the investment fund accounting. I can see a couple of questions coming up. So let me see. This is comment by Brother Muhammad Faisal. Assalamu alaikum wa alaikum assalam. Shouldn't we also exclude investment funds? This is excluded. Thank you very much, brother. This E, 3E3, 3E Roman 3 is about that. Thank you very much, brother. In the poll, there is a typo error, I think. Again, can we see the poll again on the screen? Brother Imtiaz Hussain Abbas has mentioned a typo error. It should be exit strategy. We are talking about exit strategy. But Sarah, can you show the poll again? It is exit strategy, Brother Sayyid Imtiaz Hussain Abbas, Imtiaz Abbas Hussain. This is exit strategy, which means that if I'm in a participatory venture and that participatory venture is going beyond the tolerable loss limits, there should be appropriate strategies at that given point of time to liquidate such respective liquidate or exit from such participatory ventures without putting both of the partners to further losses. So again, Sharia compliant exit strategies are where what we call Sharia compliant, because in conventional at times the exit strategies are not Sharia compliant. At time they have a capital guarantee. In Sharia we cannot have a capital guarantee. So from that perspective, we always keep a strategy in a way that the venture is liquidated in a manner that at that given point of time, there is no exploitation of either partners, but further losses are reduced. So for example, me and you started a partnership. I'm the investor and you are the working partner. And we have an agreement that we'll try to do this, and we give each other a reasonable time for like evaluating the investments. But after that reasonable time, the losses started going to go beyond a pre understood or pre-agreed limit. At that point of time, when they start going at that pace, it would be more appropriate, maybe in the benefit of both partners, that that venture is liquidated and closed and the losses to both partners are limited. However, in some situations, it may be possible that one of the partners at that point says that I want to still continue the venture. I'm still like, into it. So that is also a possibility that he can purchase the share of the other partner. Again, as I said, it should not be a form of capital guarantee. It should be after taking, the losses up to till that date. Again, whatever Sharia related requirements are there, we are not going to discuss all of them. But the point is, having an exit strategy, a Sharia compliant exit strategy, having appropriate governance structure, having appropriate financial reporting framework, it is a must. There is something that actually at times I said it in public earlier, and just recently last week, I discussed it with the Sharia committee of Sharia board. And I said that, and please just, just to try to understand again, I'm not saying I'm a very wise man, but this is something that I learned after long experiences. And maybe I can see some very respected scholars today attending, so they can confirm what I'm saying. Our Sharia committee actually kindly agreed to my comment. My comment was that in case of musharaka and mudarba and all type of Sharia compliant participatory arrangements, Sharia compliant primarily is achieved through better governance and financial reporting, and not through the contractual requirements which are according to Sharia. My point is, again, I would repeat that you can have an ideal contract, which is 100% Sharia compliant contract for a participatory venture based on musharaka or mudarba, but you cannot achieve the Sharia compliance unless the governance principles and controls are there, and unless the financial reporting is appropriately done for that venture. I know people who say, oh, I invested with a friend on a partnership basis. What are you getting? I'm talking about a friend. More than once. He said, he gives me monthly X amount of currency. How it can be Sharia compliant? Have you ever seen the financials? Have you ever seen the profit and loss computation working? Are you actually aware about how much percentage of profit is giving to you? If he's applying a two-tier profit model, was it initially agreed by you? There are a lot of points like this, which we believe are fundamentally achieved not through the contract, but through the governance and controls and through financial reporting. And I can assure you that this standard is an effort towards improving those practices, inshallah.
Brother Amar, if you'd allow me,
Yes, Brother
I
Majd.
have a question or comment if you like.
Yeah.
In the poll, we are emphasizing on applying the proper mechanisms to ensure that losses don't or are not incurred. So the question.
No, we are not saying. Let us, Sarah, can you just put the poll again?
Yeah, let's go through the poll again, because it says will result in net losses if we put in place these mechanisms.
No, the question is, what is the probability?
It may work either way, but we are putting emphasis on the resultant losses, not.
No. I think we are saying that, yeah, the question is, when you talk to Brother Majd, why we are putting this question? When you talk to the bankers, you are not a banker, you are primarily an economist. So you feel things other way around. But when you talk to the bankers, their first point is, if we do musharkas and mudarbas, we'll end up in losses. We did one musharka, we had a huge loss. We never did it again.
But it may also look at from the other perspective, the customer, the investor. That's what I feel.
Let's first understand the question, Saira. Can you put the poll again, please?
Brother, it's in the more tab.
Can you open, sir? I think everybody can open it on their screen.
Yeah, everybody can open it. It's in the more
Go
tab.
to more. Yeah, go to more. And
And then
choose polls and quizzes.
Okay. What the question is, what is the probability that a reasonably diversified portfolio of investment on Mudarba and Musharka basis will result in net losses over a period of reasonably long period if appropriate governance structures are in place? It was a typo error by Sister Saira that it should have been comma and if I should be small. So Brother Majd, I still can't understand your comment except for one part that you are probably confused about the probability.
Yeah, and we are looking at it from a different perspective. I understand.
Okay, Saira, what is the status of the poll right now? How many people have answered?
17 people. 17 people only
out of nearly 100, huh? Out of 101. Okay, maybe panelist can't answer. So
96.
out of 96, only 17 have answered. This is a bit difficult, question. Did I put a very difficult question? I'll put it as a second poll. Did I put a very difficult question? Because even our brother Majd is having that problem. Okay, let me try to explain the question again, brother Majd.
Okay.
When you talk to bankers, they simply say that we don't move Musharka and Mudarba because there is a very high risk and we cannot take that risk and we will end up in losses. We did one experience of Musharka, it was a huge loss. We did this and we just decided we'll never be doing it again.
So they shun away.
Okay. This is the situation. Probably that the majority of the banking participants here and some of the scholars that I can see who are here, they actually have this problem. They actually have noted this thing. Long time we are having this problem. Why 90% of the banks in most of the Muslim markets don't have any single musharka on the balance sheet on the asset side? Not even a single musharka.
The high probability of making losses.
Exactly. So the question is, what is the probability now? Okay, let me ask another question. We don't need a poll here. The question is, do you think majority of the businesses make loss or majority of the businesses make profit? I can assure you that majority of the businesses make profits, unless if it is not correct, then nobody in the world would do businesses. And we all understand that anybody who wants to get rich has to do business. Jobs don't make you rich. Brother Maj, you can recall we had some discussion about a famous quotation by a very senior expert that salaries are not paid to make houses.
Yeah, true. Comes the other way around.
Yes, obviously, if you are a senior executive and you are able to get financings to get a house, okay, you can try to do that. But I'm not aware of the jobs that actually allow you to have, constructions of houses just coming out of the salary, unless you have the financings available and capital available.
Yeah.
If you are having such a job, it might be a very lucky situation for very limited number of people. But the reality is that salaries are not paid for this purpose. Salaries are paid just to manage the maximum profits to the owners.
Yeah. But brother, back to the poll, I think people are having difficulty interpreting it.
Okay.
Because here the impression seems to be that if we apply these mechanisms, this will result in loss. No, it's not like that. And we didn't mean
I think my answer would be, okay, let's go like this. Sarah, can we see the answers, please? Sarah, can we see the answers? Because it's not yes, no, or a multiple choice. So effectively, a lot of people would have difficulty in putting an answer, but I want to see the answers the way they came. Sarah, if you can see the answers,
I have to
please.
download it. I will download it.
Sister
Okay,
Nov?
Sister Nov, please download it. Okay, now let me try to put my answer here. My first argument here is that businesses primarily have profits unless you mismanage them. Number two, yes, there is a probability that you do one business and it can end into a loss. That may be like 40%, 30% probability that you end up in loss. But if you do a diversified portfolio over a long period of time, the probability goes significantly down. You know what is the biggest challenge in a business? Holding position. When we talk to investment experts, they say that anybody who can hold positions, they eventually win in the markets.
True.
Which means that if you have reasonable capital available to hold the loss positions for a reasonable period of time, it will reverse over a period of time.
You'll pick up.
Initial years are investment years. You need to be able to absorb some of the losses so that you are actually able to make up the gains. Or there might be like, the bad seasons. So for example, if I sell lemonade and there is like, snow going on, maybe my lemonade won't sell in those days. So maybe I need to take out like 3 months of the year on seasonal basis. If I cannot absorb losses for those 3 months, I'll be out of business. It's a very basic example of the very starting example of like, business that normally in the Western culture is given, that you start earning as selling lemonades. But when you sell lemonade, you have to be aware that there would be different market demand. Okay, there might be weekends when you have better sales. There will be normal days when the sale will not be enough. If you purchase higher quantity of consumable and perishable goods for the purpose of having and selling lemonade, and that day you don't have enough customers coming in, you end up losses on that day. You should be able to sustain those losses for some time. If you are unable to sustain losses, after several days, you will be out of business. You need to plan your things properly. You need to be aware how much you can invest on the marketing, how much you need to invest on the marketing, how much you can invest on the product quality, how much you can compromise on the product quality. Businesses, if I don't know the business and I go to do that business, I'm sorry, I'm planning to fail. If you fail to plan, you plan to fail. But if you ask me, what is the probability that if you do a business properly, yes, the major chance is that I will be having a gain over a period of time, and particularly if it is a reasonable period of time where I have holding capacity, there is maximum probability that every business will get a gain. And when you make it a reasonably diversified portfolio, so what happens that one business may go in loss, second may go in loss, third may not go in loss, unless the whole economy destroys. That is that is a different situation if you have the whole economy going down. The question further expands that yes, there is a long-term, reasonably diversified portfolio. So even the risk or probability of losses is minimal. But when you add governance and controls, and you add appropriate financial reporting, and you add exit strategies to that, my answer to this question would be virtually nil. The probability of having losses, if there is a reasonably diversified long-term portfolio of investments in businesses on a profit and loss sharing basis, where there is appropriate financial reporting, where there is appropriate governance, and where there is appropriate Sharia compliant exit strategies, my answer to this question is it is virtually nil probability. Now, let's see what are the answers. Can we see the answers, please?
Yeah, brother, I can share the screen.
Okay, please. Let me stop sharing screen. You can put it on screen, please. Brother Latif Oilan from CMA Saudi, it's
Yeah.
0%. Yeah, his answer is close to me. Then the Sami Safi from DAB, Government of Afghanistan, because of poor risk management resulting in net loss. But we are not having poor risk management. We are having financial reporting appropriately and governance appropriately. Appropriate governance, appropriate financial reporting, and exit strategy will not be having poor risk management, brother.
Yeah.
Then we have Abdul Nasir Shakil. I think if properly managed and applied with Sharia, there will be no loss. However, the risk of acceptance of the customer. Yeah, risk of acceptance of customer, good point. Nabil Khatak, we have low probability. Yes, very low probability. Correct. Thank you. The operational of Mudarba conducted by Mudarib himself. Meanwhile, the Musharka, the conductor operation, the two parties shall make the operation collaboration. Okay, this is the general comment. We have next comment is from our brother Mufti Zahid Siraj. If the governance structure, reporting framework, exit strategies are robust, the probability of net loss can be significantly reduced. However, it is important to note that while these measures, I think his comment is not complete here. Arsalan Sajid, very low. Saddam Saidan, not much more than ordinary business. I would say that even less than ordinary business. Unforeseen market changes. This is comment from Brother Mazin Muhammad. I think, Brother Mazin, I think this is a good comment, actually, to be honest, that unforeseen market changes. The point is that if the whole economy goes away, brother, I would still say, because we talked about a diversified portfolio. So if one business, let me tell a joke. There was like when I was auditing, I was before joining AOFI, I was at the UI, and I used to do Islamic finance consulting and audits. One of my clients was having the fire engines and the fire extinguishing equipment and some of the security equipment, etc. So what happened that they were making losses, but one year they came in huge gains. Now, what I asked, what happened? They said there is a war going on in Afghanistan, so our business increased. So just try to understand that, at times, somebody dies, and if you die, somebody will gain out of it. The coffin makers and the graveyard people, they will all earn something. So maybe they might be praying that, okay, today some people should die, so we have some income. Undertaker and all that. So just keep in mind, if you are going to have a divorce, God forbid, there will be divorce lawyers who will be happy. So actually a person's gain might be other person's loss, and the other person's loss might be the first person's gain. So when we talk about the diversified portfolio, unless the whole market and whole economy goes down, unless that happens, I can assure you that the risk of loss in this given question would be virtually zero.
So
then we have comment from.
This situation, he's talking about tail risk.
He's talking about unforeseen market changes.
Tail risk,
sorry?
Tail risk.
Yeah, exactly. But again, unless the whole of the economy goes down, if COVID happens, everybody goes down. You can't do anything. It's still in COVID. Some people made big money. Courier companies make better money. Technology companies, Zoom became a giant. All the technology companies gained. A lot of companies started gaining because they use some appropriate measures to mitigate the cost and all that. Then, but the point is that even during COVID times, some of the masks, sanitizers, you had hundreds of companies coming up with sanitizers and masks. There were people on the roads that were selling masks. That created a business opportunity for them. So the reality is that yes, whole economy goes down means that this is a risk situation. Like, for example, if the whole economy becomes hyperinflationary, still there will be risk. Some of the things will be there, but I can still assure you We have seen the situation in hyperinflationary and close to hyperinflationary economies in recent years. Businesses still made good. It was the salaried class that was destroyed. It was people who got unemployed, salaried class. But still in these difficult times, because the business has an opportunity to reprice itself. Yesterday, we were having a discussion with one of the very good economic experts, and he said one thing. He was talking about Sudan several years back, and he said that when Sudan was having two different rates for for the benchmark, we were discussing the benchmark issue, and he said that there was a natural hedging. At times, they used to go for Murabaha to maintain the profit rate, make it fixed. And when they felt that hyperinflation is going on, and they felt that Murabaha will not work in that situation because of the fixed pricing, they moved to Musharka and Mudarba, getting major gains out of that. So in hyperinflation, if you see other way around, that if we were doing, instead of Mudarba or Ijara, we were doing Mudarba and Musharka in the hyperinflationary situation in the last several years in certain Muslim countries and other markets where Islamic finance is practiced, you might have found it better business. You might have found it as a better business opportunity to Musharka and Mudarba as a natural hedging against the money, because if my charging of profit is 10% and the inflation goes 15%, at the end of the year, in the net capital terms, I lose, because my purchasing power of the currency after 1 year will reduce, and because I'm having a fixed return transaction, I won't be able to make out of that. But if I made a musharka out of it, the business has the opportunity to reprice itself every day, to reduce the cost, to manage the cost better, and it might result in better returns. We can see some of the stock markets, even in these hyperinflationary times, performing very well in some of the Muslim countries. We have brother Masal Khan showed it could be, and Adnan Shafi, it should be lower provided investment are done in low risk asset. Again, brother Adnan Shafi, I'm not talking about low risk. I will still insist that it's a better diversification of portfolio that matters, not the low risk. Brother, we have FH Muse, I don't know the names, so less likely, I hope. Then we have brother Isam Hussain. Actually, my apologies, because these are email addresses, not the name, so maybe everything might not be clear. Actually, I think it is no loss with enforcing Islamic standard, because the main reason for loss is processed with haram and riba. That is the barakah part. I fully agree that Nabi Karim Sallallahu Alaihi Wasallam said that, Nabi Karim Sallallahu Alaihi Wasallam, one of the, there are multiple ahadiths that are supporting, trade and commerce. But one place Nabi Karim Sallallahu Alaihi Wasallam said that me and honest trader would be like this in Jannah. So this is like, this is where the barakah is, and this is where we have like this. And then he said another place, he said that the nine out of 10 times barakah is in tijara. So the Okamakal. So this is where that we know that there is barakah in this part. So this is what we should not be missing out. Thank you very much, sir, for identifying this point. Brother Faisal Hafiz has a point. A person with skill but with restricted access to financing is most likely to bring his venture into profit. Given that, diversification will further improve chances of success. Brother Faisal, thank you very much. You are right to the point. We have comment from Brother Mullah. Diversified portfolio can earn good returns if good Sharia compliance strategies applied. Thank you very much. I think we are almost on the same page. Almost majority answered the same. Now I'll move to the Q&A tab before I share my... Okay, there are comments coming on. We have comment from Brother Praveen Manik from KPMG. With a good governance structure and appropriate exit strategies in place, there would be less likely to incur net losses over a longer period. Thank you very much. We have comment from my dear brother Intisar. Assalamu alaikum. If governance structure and sponsors integrity, it's very important to avoid losses. This is correct. That's why we made it condition. But I can tell you, brother Intisar, while we fully agree that integrity is important, but integrity issues can be managed through better governance, better financial reporting, and exit strategies. You would agree, I hope. Then we come to Brother Hassan Ilyas. There will be a small probability of getting losses on such diversified portfolio. That is correct, very small probability. We have FZ92110. As a general rule, loss would be minimum. However, government support for effective laws and effective legal system would be more important. Fully agreed. M. Rahim Al-Hayat MFB, 10% means that he wants to say that it's a very less probability. Brother Junaid Kasbati from Salama Insure Takaful, the probability will be result in net losses is low, provided that appropriate governance and other things are in place. I think as text is cut here. Okay. So, sister, I think we can just understand the answer is more or less the same by majority. Agreeing to what I wanted to mention, that the probability will be very less in this situation. We have some comments in the Q&A tab. Let's take one by one. So I have already answered Brother Imtiaz Abbas Hussain about exit strategy. We have a comment from Brother Latif Ulyan, Latif from Capital Market Authority in KSA. Welcome, Brother Latif. Thank you for hard work and opportunity to participate in the hearing. Please find below my questions and comments on the ED for your review. 4F, very frequent basis. Is there any guidance for this? Okay, it is excellent comments, Brother Latif. Sister Saira, can you just help me with this thing, because Brother Latif has comments on para by para, so we will take them para by para. Brother Latif, thank you very much. These comments will be taken to working group also, and will whatever needs an answer, I'll provide answers when we reach the respective paras. It will be better for all of us. Okay, so thank you. I will be addressing these ones. Brother Imtiaz Abbas Hussain has another comment. What is the use of governance and activities that are Sharia compliant? Because Sharia compliant already included principle of Allah fearing. Brother Sayyid Imtiaz Abbas Hussain, there can be no society purer than the times of Nabi Karim Sallallahu Alaihi Wasallam. But we know that there were times, even on those times, there were some hudud that were enacted. Just keep in mind. And you know that even at that time, Allah subhanahu wa ta'ala says that there are munafiqun between them. Just try to understand that no society, because of the human issues, can be perfect. And on a lighter note, greed comes before Allah fearing. This takes a huge effort that you kill your greed and become Allah fearing. Even within a Muslim society, and again, Brother Imtiaz, if you have a Sharia compliant contract, does not make people very honest. Let's know the realities. We have everyday situation that people do partnerships with each other, and you have this long beards and all that. And unfortunately, I would say, based on some of the market practices in some of the Muslim countries, the bigger fraudulent activities were done people with the impression of being religious, God forbid. Because I would again say, Islam and Sharia is not about Zahir. It's not about how you appear as a Sharia compliant person. It is really comes from the heart. That would it be possible that nobody is looking at you and you still try to follow the path of Allah just out of fear of Allah or out of love for Allah, if it is like, the higher level. So the reality is, let me tell a small joke that a lot of people share. They say that a person is honest till the time he doesn't have the opportunity. So that issue also is there, to be honest. The test is when you have, for example, if I live in a society where no alcohol is available, I have no test. The question will be when I travel outside and I have alcohol bottle in my, the cabinet of the cabinet of the hotel room, and nobody can see me. That is the test whether I apply the Allah-fearing conduct at that point of time or not. Same applies in all the business dealings. I have an opportunity in my hand to deceive my partner. Am I going to do that? There is a risk. And that's why we are asking appropriate financial reporting, governance practices, and exit strategies. Thank you very much, brother. But I can tell you, we don't live in the society of angels. We should not be waiting that everybody will be an angel and a very pious person and very Allah-fearing person. Then we will start musharka and mudarba. That is actually, a chicken and egg situation. Okay, we don't do musharka mudarba till the time people don't become pious and till the time society doesn't become fully Sharia compliant. And on the other hand, I can tell you that it is quite possible that a person who appears religious is dishonest in dealings, and a person who appears not to be religious and at times not even a Muslim, and he turns out to be more honest in dealings. Let's be honest, this is the reality in some of the markets that we can deal with those institutions in some of the non-Muslim countries with more confidence as compared to some of our own brothers. So thank you very much for your comment. We have comment from Brother Nabil Najib. Sir, your insight is valuable regarding that achieving Sharia compliance reliance or a robust governance. Thank you very much, brother. A good example is the practice of distributing investment wakala profit based on expected returns, often without proper governance or accurate reporting. How can this practice be streamlined to achieve Sharia compliance? My dear brother, we have issued FAS 31, Financial Accounting Standard number 31, which deals the financial reporting part. We have issued exposure draft of investment accounts standard, which addresses some of the issues related to the governance of wakala. We have issued governance standard number 12 on the sukuk, which include obviously the sukuk al-wakala. So the governance requirements of sukuk al-wakala are covered in GS12 as well. So effectively, I would say that we have tried that in different standards on the governance and financial reporting side to address it. But we believe that you cannot just give accrual of return. And that is one of the challenges that is in this standard as well, that the return on musharka, mudarba, and wakala cannot be accrued. Let me repeat. Return on musharka, mudarba, wakala cannot be accrued like conventional interest. This is a subsequent measurement issue, which was not very well established in our earlier FAS 27 or not. It was understood, but it was not written in writing very clearly that you need to apply subsequent measurement, not based on accrual, but actual based on profit and loss distribution. This is what was written already in FAS 3 and 4, that profit distribution on wakala is the basis for recognizing revenue. Accrual is not the basis of recognizing revenue. In case of FAS 3 and FAS 4, it was already written. But how to do it at the back end was not provided for. So this standard actually addresses that issue as well. Similarly, in case of FAS 31, we have wakala venture approach and pass-through accounting approach, and according to which appropriate accounting needs to be done before actually determining the return. There is a misconception in people and some of the banking practices which are like, that since we are having a wakala product which is very similar to conventional in the end, so we just try to accrue returns and we just try to do the accounting, and even we don't apply proper governance practices, etc. on that. We at AOFI are trying to address these issues. Thank you very much for your very important comment and for your kind words. Thank you. We have comment from Sister Farah. I think it is Sister Farah, how important is to look into impact of businesses on the society to determine the profit. Apart from conventional impact like IRSG, IUN, UN, and SDGs you are talking about, I think, do you think there should be an impact assessment, Islamic impact assessment criteria, measurement criteria? It's a good point, very good point. We are working on a responsible finance standard, which will be an update on the corporate social responsibility standard. So some of these aspects, inshallah, will be covered in that standard. But we believe that even our Sharia decision-making standard recently has emphasized, the final standard will be out in the market soon, but exposure draft is already available. So we are emphasizing in our governance and Sharia standards on the following, on the Maqasid Sharia as well. Maqasid Sharia it should be our first, preference before going to the conventional ones, because while we are fully open to adopt any good practices that are coming from the conventional side, but at times the ethical behavior definition for us and them might be different, and the gender equality definition for them and us would be different. And being equal opportunity employer, what does it mean? Might differ according to our values and their values. So there are some of the things where the values which are taken from the social system cannot be taken without, you cannot take it without a pinch of salt, what do you say? So effectively, yes, we are trying to work on the conventional guidelines available on sustainability, responsible finance, and all that, and we are committed to work on that. But with COP28, we and some other Islamic financial infrastructure bodies issued a combined statement as well about our commitment on that area. But we still believe that the way these are seen on the conventional world might slightly need to be altered. There are some universal good ethics. Okay, telling the lie is bad and telling the truth is good. This is universal ethic. But there might be some situations where the way you interpret these things would be different. Okay, so thank you very much for your kind comment, and there is a commitment, as I assure, on our part to work with for Maqasid, and the Maqasid are being covered in this one, SDM standard and upcoming responsible finance standard. We are also thinking of adding, this aspect of Maqasid. Okay, maybe I have talked a lot about the background things and less about the about the actual, the standard till now. So now we need to focus on the standard. Another exclusion of from this standard is investments in corporate entities having parent, subsidiary, associate, or joint venture relationship, or investment through trust, which shall be accounted for in line with requirements of respective pairs. So if it's a corporate entity as a venture or an associate, these all are not part of the scope of this one. Coming to the definitions, control is as defined in the definition of in the control standard. Brother Majd, I think at times we put a footnote in that situation. We just refer but put a footnote. So I think it would be still good that if we create a clear reference, because the standard number one, the ED has been finalized. So we need to update it to the final standard number. I think it's FAS 44. And then second part is that we might need to reproduce the definition in the footnote as well. Mudarba is as defined in UFI conceptual framework for financial reporting. Musharaka in the specific, again, I would say that this should be better if we can provide a footnote. Musharaka in the specific context of the standard is a partnership based on Shirkatullah, whereby two or more parties agree to combine their assets, labor, entrepreneurship, financial commitments, and or goodwill for the purpose of making profit. This is a very comprehensive definition that we have coined in as a new definition. So we'll expect if you feel it is satisfactory with that or have comments. Participatory structure is also defined in FAS on control of assets and business. Sharia compliant participatory venture. Okay, just let me go to this scope. Brother Majd, I think we need to just take a note of this point, because I think that earlier we were using the Sharia compliant participatory venture as the uniform term. I think we just need to align that. Okay, we refer to 4E here, or which one? It is referring to 4D, not 4E. Can we recheck the references, Brother Majd? My suggestion is, Brother Majd, only in the scope we write Sharia compliant participatory venture and keep this definition. Then we continue using participatory ventures. But I think this was some discussion in the accounting board as well. So we need to see. Let me put a question to the participants here.
Actually, Brother Ahmad, there was a discussion, sorry to interrupt. And they said, okay, in the definition, we give the proper full name, and then later on, we only use participatory venture.
Okay. Thank you very much for correction. Now let me put the question to the participants. If you can just provide a comment, because the name of the standard, we discussed at one point of time that it should be considered as Sharia compliant participatory ventures, and the second option was participatory ventures. We stuck to the definition that participatory ventures. However, there was a discussion and there was some difference opinion on this part as well, because some people felt that there might be a confusion with other types of participative and joint ventures which are under IFRS. And we were afraid that there might be some confusion about it. I think that decision, as Brother Majd has referred to, about keeping the full definition here, I think this is it is very important that we just keep it in mind that the confusion in the market should not be created. So if you feel that providing this definition would be okay, then and only in the definition we mention Sharia compliant participative venture, while we continue the standard as a participative venture standard in terms of name and in terms of wherever you have used the term, we'll use it like this. Just a question, Brother Majd, to you and Sister Saira. SCPV, are we still using SCPV as the term or participative venture as the term?
Across the standard, no, that's only in this place, I think. But
so because earlier version of the standard when we were working on was using SCPV, so here we should say SCPV oblique participative venture, then or we should say maybe hereinafter it refers to hereinafter referred to as participative ventures, something like this.
That seems
but just make a note of it, and even the reference is not correct, that need to be corrected. Our apologies to the participants, because I think this was a confusion, and I think this was one of the questions that we were having. Let me see the question. Brother Latif Ulian has one question on this definition, I think. No, he has on 4F. Okay. Very frequent basis. You want a clarification on the very frequent basis. Okay, thank you very much. We are saying variable equity participative venture is a type of participative venture. So, okay, our earlier standard was talking about diminishing musharka. But the Mudarba standard was not talking about if Mudarba is also having a reduction in equity, on a periodic basis. So for example, if there is a Mudarba, which is also diminishing in nature, which means my capital is also paid off by the working partner in some time, that was not covered exactly the same way. So secondly, now there is another practice in one of the markets at least, and that we believe is a good product with some improvement. It can be applied around the globe. That is called running musharka. So we say that variable equity participative venture. So we are not using that. And there was one more reason that we did not want to use the diminishing musharka term, because diminishing musharka is now used in certain markets with shirkatul milk. So better term that we decided here was variable equity participative venture is a type of participative venture in which the respective amount of quasi-equity contributed by the investor as well as the working partner remains variable through ongoing downwards and redemptions by the working partner on a very frequent basis, normally subject to a maximum limit of such quasi-equity contributed by the investors. Explanation: the most common form of variable equity participative venture is running musharka, although certain other musharka-based and mudarba-based products and instruments may also classify as such. This is a question about very frequent. Now, that very frequent is a good question by our brother Latif Ulian. Thank you very much, brother, for raising a very good question. I think it would be good if we discuss it with the working group and the board to either provide an example in the footnote or provide some guidance in the basis of conclusion that what we very frequent means. Thank you very much. I think it's a good comment. We just need to provide some clarification. Working partner. Now, working partner is a term that we are using in terms of participative venture, which may include a mudarib and which may include a working partner of the musharka. So working partner is a partner in a participative venture, principally entitled to manage and or operate such participative venture and who receives equity contributions from the investors. Working partner at times may also commingle its own equity in the participative venture. Explanation: a working partner, depending on the nature of the underlying contract, may generally include a mudarib or a musharka as working partner. Do we have any other comment on the definitions? 4G. If a working partner only receives the salary, would the requirement apply? No. Working partner, if receives only a salary, it would not apply. The answer is no. Can a party be both an investor and a working partner? In that situation, we are saying that working partner it remains a working partner, but he can commingle his money. We have already said that he can commingle his money. So that is there. And then in the standard, we have clarified if the working partner commingles his money, what will be the accounting for that? That in line with Sharia. So that is covered already. Okay, so you have two comments on 4F and 4G. I think I have answered these comments, and I think we are taking a note. We have comment from Brother Nabil Najib. What is meant by virtual entity, not legal entity? Yes, the answer is correct. AOFI has a virtual entity concept. Again, IFRS and others also have with this one. The concept is that a virtual entity is a situation where you do not constitute a legal entity, but you do a venture in partnership. So for example, me and you do a agreement of musharka that both of us will be having a business of investment in something together. Now this instrument, which is a Sharia compliant contract of musharka between us, this instrument created a virtual entity automatically. Now, we can give this entity a legal status by creating a corporate entity. So we created a corporate entity, and that corporate entity becomes however I would say that corporate entity has its own share capital and everything. So it becomes an entity, legal entity in itself. In that situation, this standard will not apply. The entity will be applying normal AOFI and IFRS. Now, if both of us created in some countries, there are registered partnership laws also. So if we also created a registered partnership, that also for us, so that we are not using the term corporate entity, we are using the term legal entity. So the partnership law in different jurisdictions is different. In most jurisdictions, partnership law keeps each partner individually and jointly and severally liable. So if it is jointly and severally liable situation, that can also constitute a legal entity according to the law of that country. If we get it registered as an entity and we get a registration certificate as an entity and we get registered with the legal authorities and tax authorities as an entity, that again goes out of ambit of this standard. But whenever we do a contract like this, now let's take another example. There is an example that there is a bank which created a partnership under Musharka with a corporate entity. Now that corporate entity created an asset pool and the bank became partner in that asset pool according to Musharka agreement. Now this corporate entity did not create any form of legal separate registration, legal separate documentation except for the Musharka agreement for the purpose of this pool of assets. Or let's take example of pools of assets in Islamic banks. Each pool of assets in Islamic banks becomes a virtual entity because the stakeholders who own the underlying assets are different. So considering all these situations, AOFI standards have a proper consideration under the framework and in several standards with regard to having a virtual entity. So I think this definition, this clarification would be good enough. I hope so. We have defined, I think, even the Islamic finance window, according to us, it becomes a virtual entity in a conventional bank. The first point is about assessment of control. So we are saying that accounting and financial reporting approach suitable for participative venture shall be assessed by determining the extent of control by the investor and the working partner on the participative venture. In the control standard, we have a table provided that Sister Saira and Brother Majd, if we can have that table inserted at the end of this presentation also, just for the purpose of right now I don't have this one available for me. But the idea is that if we can have a very quick look in the upcoming public hearings on that one to explain this thing. But in a nutshell, if the working partner controls, then the venture remains on balance sheet for the working partner. The extent of control over participative venture and the assets underlying the participative venture where applicable shall be assessed in line with the definition of control and the table as I mentioned. An assessment to the extent of control in line with the requirement of paragraph 5 shall result, it is not paragraph 5, it is paragraph 5. shall result in one of the following conclusions. A, the participative venture is controlled by investors. See paragraph 8, 9, and 8, 9A and 31. So if the participative venture is controlled by the investors, accounting is different. B, the participative venture is controlled by the working partner, accounting may become different. If the participative venture is under shared control, third situation, shared control, situation may become different. Now, these are the paragraphs that are referenced. Now, summary of the accounting approaches. 8A, if the controlling party, investor controls the participatory venture, the accounting treatment by the investor would be pass-through accounting approach and or net investment in participatory venture accounting approach if pass-through approach is impracticable. The working partner will be having off-balance sheet accounting. Means that if working partner is not controlling, like in Wakala, working partner does not, the agent does not control. So we keep things off balance sheet for working partners. Same applies here. The second situation is working partner controls the participatory venture, which is the most common situation. Most of the, will be going in B and C. Net investment in participatory venture accounting approach will be followed, which is the more common approach that will be followed. And for the working partner, quasi-equity accounting approach will be followed again, which is the more common approach. C, if investor and working partner have shared control over the participative venture, then both of them will apply net investment in participative venture accounting approach, and it partially addresses that issue also about the what we discussed earlier, that if the investor has also, the working partner has also commingled his own funds and effectively it becomes a joint control, that what will happen. Brother Latif has a question on para 8 also, so let's go to his questions. Can a party be both an investor and a working partner? If yes, how the guidance would work? We are saying that participatory venture, this is the situation where investor and working partner have shared control. So some of those situations will become shared control. We have defined the accounting. This accounting further clarification is provided in the respective paragraphs. Then perpetual participatory venture. Perpetual participatory venture is the situation that continues for a longer period of time without having a redemption option. Redemption of let me try to explain this issue. In a Musharka, I am an investor, I am a partner. Musharkas normally, according to our practices, have a maturity or have a running balance or diminishing approach. So according to IFRS, any instrument, financial instrument that has a put option in the hand of the investor, it becomes a liability for the investee, and a debt type instrument for effectively it becomes debt type instrument for the investor. According to Sharia, we do not have a liability of the investee because he does not guarantee the capital, does not guarantee the return. And the investor owns proportionate assets and underlying net assets, which means that according to Sharia, it's primarily equity. However, since it has a put option in the hand of the investor or a maturity of the transaction, we created a classification of quasi-equity. That quasi-equity is a unique type of equity under Sharia compliant contracts, which is having primary characteristic of equity, but it has certain characteristics of a liability, for example, having the put option or a redemption option. Just to check, I think quasi-equity definition is understood, that will be coming from there, but I think we may need to create a cross-reference for the quasi-equity definition also, Brother Majid, because we have addressed the quasi-equity type treatment in this one. So now if I issue a sukuk, which is having a perpetual equity, or if I issue a unique type of preference shares, which has no redemption option. So some of these type of participatory ventures which are having a perpetuity, or like either they don't have any option of encashment on the hand of the investor, although the investee may decide on that, or there is a conversion option. So perpetuity or convertibility is there. In that situation, it may be considered as equity, although some of the accounting treatments from the quasi-equity approach will be followed. This will apply to some of the sukuk which are issued or some Sharia compliant preference shares that are issued by corporate entities. Participatory ventures involving gradual transfer of ownership. So this is like diminishing musharaka situation. So normally net investment in participatory venture accounting approach and quasi-equity accounting approach will be applied. Brother Majd, in participatory investment approach, if pass-through accounting approach is not impracticable, this point I think we need to recheck based on the final discussions in the working group and the board.
Actually, on that point, it happened in two places, and for that we are writing a BOC. It is in the BOC, but here for para E, we can resubmit.
No, I think it is not needed here.
Okay.
With gradual transfer, participative venture, this if pass-through accounting approach is impracticable. Actually, for gradual transfer, I think it was understood that pass-through is unapplicable. I think there is this, for me, it's a typo error unless there was some discussion in the board or working group, which I may not recall. But for me, it's a typo error. This one applies in A. This does not apply in gradual transfer situation. Because in gradual transfer situation, effectively, gradual transfer situation becomes shared control. So if gradual transfer situation becomes share controlled, then in that situation, net investment approach should be applied. Got it? And even if you see on the counterpart, we are just asking for the equity approach, not the off-balance sheet approach. So for me, it's a typo error, but we need to check it in line with the final discussions with the board and the working group. Okay, just a question. I think we were supposed to take a 10 minutes or 15 minutes break for prayers and maybe people need to stretch their legs. I think we decided to take it at 11:45 or 12. Shall we take a break at this point, Brother Majd? I think prayer time has started in Bahrain.
And we resume by 12.
Yeah. So we just take a break right now, just a quick break. We just stretch our legs and pray in between for the markets where we have prayer time already. So we'll just continue after this with the next section, inshallah. Please keep connected and be available. Thank you very much for having your patience.
Please keep connected and we'll resume after 15 minutes, inshallah.
Brother Majd, I think we should start.
Yes. Please, we can start. We have, I think, everybody is almost there.
Okay, Bismillahirrahmanirrahim, and welcome again. Thanks for being connected. I think majority is still connected, and we hope that others will join back, inshallah. So we were at this point of going to the accounting part. So initially we assessed how different type of participative ventures will be classified for accounting and financial reporting purposes. So we have different approaches that we decided, and some of them will be following similar approach and some of them will be following a different approach as per the table that we discussed above. I can see a couple of questions coming up. One was already there from Brother Latif Ulyan, but we'll see if we have other questions. So now we have question from Dr. Muhammad Raza Hussain. What is working partner? What is the main characteristic of working partner? Brother Raza Hussain, if you see the working partner is, if you see, this is a well-defined here. Working partner is a partner in a participative venture principally entitled to manage and or operate such participative venture and who receives equity contributions from the investors. Working partner at time may also commingle its own equity in the participative venture. Explanation: a working partner, depending on the nature of the underlying contract, may generally include a mudarib or a musharka's working partner. I think this is good enough, but you have further clarification requests, please let us know. Okay, so then we continue our discussion. So now, and accounting and financial reporting approaches by the investor. So right now, first we are talking about accounting by the investor. So we are saying that the table that we already discussed, but we are saying in case of participative venture is controlled by the investor only, the pass-through approach will be followed. In all other cases, including the case where participative venture is controlled either by the working partner or under shared control and the working partner, the net investment method will be used. Brother Majd, this re-clarifies what I said earlier about that maybe a typo error in the presentation. We just need to check whether it's in the presentation or it's in the standard, but we need to be clear that if it is controlled by the investor, if all other situations, it will be net investment in participative venture accounting approach. Okay. So now for investor, we have two approaches. First approach, participatory venture approach. First is pass-through accounting approach. The second is participatory venture approach. Pass-through accounting approach, if those of you who have read AOFI FAS 31 on Wakala Venture, Wakalas and Wakala Venture accounting, you might also see that there also we have pass-through approach and Wakala Venture approach. Now, what is pass-through approach? Pass-through approach is that since the investor principally owns and controls the assets of the underlying venture and the mudarib is under a restricted mudarba arrangement, only managing it, but does not have a real risk or reward, and particularly does not have real risk with regard to the underlying assets, then working partner or mudarib shouldn't be recording it in its book. Rather, it should be recorded directly in the books of the agent. So for example, me and Brother Majd create a venture in which I give, for example, I give Brother Majd to 500 BD, and I say, Brother Majd, this 500 BD I want to invest through you in a very specific venture, identified investment, and I say 20% profit will be yours, and whole risk of loss for sure is mine, and he's not entitled to commingle his own funds. This is one example where Brother Majd is having very clear discretion, no discretion and clear guidance where he has to invest that money. So effectively, it's a restricted mudarba situation where Brother Majd does not control and I control directly. So the correct accounting would be that I would be recording it directly in my books. And Brother Majd will be showing it only as an off-balance sheet managed asset. This is the accounting treatment, which we believe principally is not even against IFRS. And this is aligned with FAS 31 also, where in case of Wakala, where the investor controls and the Vakil does not control the asset, the primary accounting treatment is passed through. However, we know that at times pass-through becomes impracticable. So in those situations, even where pass-through become impracticable, even if it is applicable, but became impracticable because of limitation of information or other issues, Wakala participatory venture approach will be followed. Same approach is in FAS 31 where Wakala venture approach is followed. Now, let's first go to the pass-through approach. Again, I can mention based on our experience and based on what we have seen in the market, there will be very rare examples of pass-through accounting approach. But yes, this is like, the true essence that if the situation is like this, then pass-through approach should be followed. On initial recognition, using the pass-through accounting approach, the investor shall recognize the assets as well as liabilities, if any, underlying the participatory ventures and in books of account, applying the initial recognition principles that are applicable in line with relevant OP phases. Proportionate assets and liabilities shall be recognized applying the same principles in case where the arrangement has more than one investor. So there are 3 investors working with Brother Majd. Now, 3 investors invested 33% each. For Brother Majd, in this situation, since he has very clear directions that he has to follow this, for him it is an off-balance sheet managed asset. But for the 3 investors, it is a proportionate asset that they need to show in the books. And I can tell you that this is in line with the venture accounting also. In case of oil and gas ventures, and others experts amongst you might well understand that if there is a venture situation in oil and gas also, oil and gas and other businesses, venture not having a legal entity situation, even this pass-through thing is done. So we are not saying that we are going against IFRS or something. We are just clarifying what is the right approach. Subsequent to initial measurement, again, it will be like, whatever accounting policy applies, that should be applied according to that. For example, if there are assets, you will be depreciating them. The investor will be doing all of it. An investor shall determine at each period and impairment also. And the settlement risk can also be considered for impairment purpose. This is an important point, that while impairment will be considered, but there is a risk of settlement also. Like, for example, if you have an exit strategy issue, that you have an exit, a clause cannot be applied properly, or you don't have an exit clause, in those situations, there might be a risk that in case of impairment, there might be a settlement risk as well. So that also need to be considered for impairment purposes. According to FAS 30, you will be doing the impairment testing and you will be applying that. But just keep in mind that according to FAS 30, receivables are subject to credit losses and other assets are subject to impairment. So this will be subject to impairment, not credit losses. Unless contrary to a specific requirement of the standard, the resulting revenue, expenses, gains, and losses arising from participatory ventures shall be measured and accounted for respectively in accordance with the nature of contract in line with the requirements of respective OFIF as applicable to such transactions. And normal accounting policies of the investor shall apply in respect of all such matters. Revenue, expenses, gains, and losses shall be recognized on a gross basis, that the same shall be included in respective line items in the financial statement of the investor. You have to add revenue in revenues, expenses in expenses, because this is a pass-through investment, which means that you are just having a working partner which was functioning primarily as an agent without control, and you keep the control, and effectively you add the revenue to revenues, asset to assets, liability to liabilities, and expenses to expenses. Now, I think we have received a couple of more questions, so let me try to take them. Brother Assam Mohsin has a question. I'm sorry for missed the number of paragraph, but it is the definition about the virtual bodies. I think we should include this body is written contract or not, like Mahasa. Brother Assam, thank you very much for your comment. We did not provide the virtual body definition in this standard. We just use the term virtual entity. So we'll take your point to the working group and we'll see how they respond to it. If they feel there is a need for making an amendment or making some clarification, a footnote, BOC, we'll see what needs to be done. We'll highly appreciate if you explain it, again, we'll take the point to the working group, inshallah. Thank you very much for your kind comment. Then we have a point from Brother Abdul Nasir Harsi Jama. Can earn salary from investor as well as controlling part? No. According to the Conventional Partnership Act, you have this situation, but according to this standard, you don't have it. But yes, just one thing. There is just one thing. There is a situation for Mudarib where he is entitled to some Ujratul Misl. That is a very unique situation. I think that applies according to certain Sharia conditions in some situations of Mudarba. But generally speaking, answer to your question is no. But Brother Majd, I will request you that just keep in mind that because Sharia, in some law situations, some of this, again, every Sharia standards don't make it mandatory, but it is accepted by some Sharia, are preferred by certain scholars that it should be applicable, that some ujra should be paid to Mudarib even in case of loss, like in equivalent to Ujratul Misl. So we'll just recheck what is the requirement of Sharia standard in this part, but I think Sharia standard doesn't require it, but does it allow it or don't allow it? If Sharia standard allows it, which is allowed by other scholars we know, we may consider it like, as a, but it will be applicable in the loss situation, not in the gain situation. You cannot we have a fixed, Sharia standard clearly say that you cannot have fixed share of proportion for the partners. Thank you very much. The working partner share of profit payable according to contractual payable. Now, just keep in mind, here we are investor and we will record what is payable to the working partner. It won't be other way around. Normally, we understand that working partner will be showing our profit. It is other way around, that we need to recognize whole of the revenue expenses in our books, and then working partner share of profit according to contractual obligation shall be recognized and expense on the financial reporting period on the best estimate of account amounts payable as at the respective period end based on contractual and constructive obligation. Contractual obligation is what is the direct percentage of profit. Constructive obligation is if there is a incentive profit expected to be paid, you need, and based on the best estimate of that constructive obligation part, you need to record that also. Any contingent or conditional variable shares of profit payable to the working partner as per contractual terms shall be recognized as an expense based on the best estimates of the same, applying the following principles. Variable share of profit related to, some of these things are similar to FAS 31. Variable share of profit related to performance based on contractual arrangement shall be recognized as a liability when it becomes due on accrual basis. And variable share of profit accrual to past performance, which is contingently reversible on a cumulative basis. For example, reversal in case of future loss or is contingently dependent on decision of a third party, shall be recognized as a liability when due, irrespective of probability of their reversal. Brother might just make a note of it on an accrual basis. We might need to clarify this wording, or maybe which is okay as a liability when it becomes due might be good enough. Okay. I just don't want to create a confusion because of using of work accrual, because when we say liability when it becomes due, it means that it will be done on the period end. So people use of word accrual here. Reversal of a liability earlier recorded in line with B above to recover loss or against below par performance shall be recognized as a reduction of respective expense in the period of such reversal occur, and variable share of profit related to or fully dependent on future performance of the working partner shall not be recognized, which means that if there is an expectation that the future incentive will be paid, it will not be recognized in this situation. In the event of a negligence by the working partner determined in line with the Sharia principles and rules, amount recoverable from the working partner shall be recognized as an income and recorded as receivable from the working partner at the time such negligence is established and the amount of compensation of loss is determined. Presentation and disclosure, in a nutshell, a line-by-line items will be added. However, it shall be presented and disclosed in a manner that same can be identified in relation to the participatory venture through additional disclosures. The working partner share of profit determined in line with just one thing. Sorry, my apologies here. The working partner share of profit determined in line with the requirements of paragraph 15 to 17. Brother Maj, there should not be a space between 15 to 17. Okay. 15 and 17 hyphen should be without space. Shall be included in related expenses and disclosed appropriately. Then we need to provide summary of contractual relationship, ownership structure of participatory venture, etc., and some other disclosures. But again, there is an argument that this will be applied to minimum disclosure requirements are there. So they will be provided in the respective notes, etc. And one important disclosure is any contingent variable profit payable not recognized as a liability at this point of time, that should also be disclosed as a contingency. Now, this was the first treatment, accounting by investor under net investment method. Now, this is the most common method under net investment in participatory venture accounting approach. This is mainly appearing for the investor, but even the investee, if it has shared control, in some situations, it will also apply this accounting. So we have initial recognition. While applying the net investment in participatory venture accounting approach, an investor shall initially recognize the net investment made as an investment in a participatory venture at cost at the time when it is made available to the respective working partner for investment. In case of investment in kind, the initial recognition shall be based on on the fair value of the in-kind investment at the date of investment. So if you started Mudarba by passing on an asset, you need to do a fair value of that, and then that value will be considered as the capital. The asset will itself become part of the joint venture or the participatory venture, not alone by you. In case the investor has made investment available to the prospective working partner, but the contract is yet to be initiated, such amount shall be initially recognized as an advance against investment in the participatory venture till the time such contract is initiated. The investment in a subsequent measurement. The investment in a participatory venture shall be measured at the end of financial reporting period at carrying amount adjusted for additional capital contribution, capital withdrawals, and payment of distributable profits, and shall be adjusted to include the net share of profit or loss of the participatory venture as attributable to the investor under the contractual arrangements as determined under relevant OFIFAS as of that date. So what happens? You recognize the initial investment, and at the end of the period, you recognize it at the carrying value, that is the initial capital plus adjustments or withdrawal of capital, etc. And then you add the net share of profit or loss from the participatory venture to that. So that becomes as a combined, obviously you will have a disclosure for that, but it becomes a new carrying value, which means, as I said, like conventional, you won't be doing any accruals on that. It will be dependent on actual profit and loss distribution. Net share of the profit and losses duly comprising the net result of revenues, expenses, gain, and losses arising from this investment is a participatory venture shall be determined after allocation of the working partner share of profit, including variable profit. Just keep in mind that for this accounting, you need to have a back-end accounting of the investment pool or the investment venture itself. That is also a requirement of the standard. So this standard applies for accounting for the investor, for the working partner, or what we call investee, as well as the venture, that is the virtual entity as a partnership. That also is subject to basic minimum accounting, because that will be the basis of profit and loss determination, which will be used for determining the working partner and the investor shares. Then it's not necessary that I read out everything, but I will just try to explain the things, and obviously we are open for all the comments. But just to summarize that this accounting is similar to the accounting that we have defined in the FAS 31 for the investment in Wakala Venture. And the difference is the profit or loss determination or the working partner share determination here is slightly different as compared to what is there for the investment agent in case of FAS 31. But however, we are saying that any share of losses, if because of negligence there is a share of losses, that obviously has to be shown as a recoverable, and it will be shown as a reduction in losses if it is established. And once it is established, before establishing, you can't reduce it from share of losses, but once it is established, you record it separately as a receivable and show as a reduction in losses. In case of impairment, obviously, it will be subject to impairment testing. And again, as I said, not to expected credit loss testing, but to impairment testing. Then we have disclosure requirements with regard to the share of profits and losses coming from that, and the investor shall also disclose the following as a summary of principal terms and condition of the ventures and the nature of underlying assets and the contingent profit payable to working partner. Again, there is one question I remember we discussed in the working group that if investor has maybe so many investments under this, what happens? Like a bank is there which may have 500 investment ventures like this. So obviously, all such disclosures in those situations will apply on a cumulative basis. If something individual is material that need to be disclosed, otherwise cumulative disclosures will be needed for the whole portfolio. Now, this is the other side accounting. So that was the first accounting for the investor, where we have two approaches. Pass-through, which applies in very limited situation, where we have a technically only applies on restricted Mudarba type situations where we control the assets completely. We don't share the control, or the working partner doesn't control. And we have, with that accounting is type 1. The type 2 accounting is where we have a participatory venture and we do a net investment in participatory venture approach. And that is that approach is quite similar to what is already there in Phase 3 and Phase 4. We just improved the word, and also in Phase 31. Now, accounting and financial reporting, which approaches for the working partner, we discussed in the table earlier, but we'll come here as well, because this is the table actually just explains a summary, but this is what is the text of the standard. Now, the working partner shall apply any of the following approaches for accounting, financial reporting in a participative venture. In case of participative venture is controlled by the investor only, off-balance sheet accounting approach will be followed. In case the participative venture is controlled by working partner only, quasi-equity accounting approach will be followed. In case the participative venture is under shared control of the investor and the working partner, the net investment in participatory venture accounting approach similar to that of investor may be followed. Now, so what are the three primary treatments? First, if investor controls, you do the participatory venture approach. Pass-through approach. The equivalent to pass-through approach is off-balance sheet approach. If the participatory venture is controlled by the working partner will be applying quasi-equity approach, while the investor will be applying net investment in participatory venture approach. In case you are having a shared control, or in case that also applies if there are more than one working partners. So effectively it becomes, if there are more than one working partners, then it effectively becomes a shared control. So if the shared control is established in that situation, the working partner also becomes an investor. So the working partner will also be doing the net investment in participatory venture accounting approach similar to the investor. Because of the shared control, he became an investor himself, because this is its primary capacity as an investor. Now, under the off-balance sheet accounting approach, this approach would be quite similar to that they will be preparing a statement of off-balance sheet managed asset, but will not be, or if it is following not following AOFI FAS, not being a full financial institution under AOFI, obviously it will be de-recognizing the assets and not recognizing any assets, liabilities, revenues, only recognizing its net share of profit and loss coming and making appropriate disclosures on that part. Here there is a slight catch. On the investor side, on the investee side versus investor side, the prudence and that more likely that not and the virtual certainty issue are there. So if I'm doing off-balance sheet accounting approach, investor share of profit, net share of the profit duly comprising net result of revenue arising from investment participatory venture after allocating the investor share of profit shall be recognized periodically. Any share of losses, brother Maj, about this heading, we need to see what is the proper heading. I think we should need to talk about, in this one, we need to talk about appropriation of profits and losses. The heading might need to be improved. Any share of losses reimbursable to the investor as established in line with Sharia. Just keep a note of it. We'll see what is better, but just keep a note of it. Any share of losses reimbursable to the investor as established in line with Sharia principle and rule, as we talked about, due to working partner negligence and misconduct shall be recognized as an expense as and when due. Investor's share of profit. Contingent conditional share of profit receivable by the working partner as per contractual terms shall be recognized when there remains no material uncertainty with regard to its recoverability, including applying the following principles. So what we are saying, when it is virtually certain, when there remains no material uncertainty. So I am entitled to additional incentive profits. So I cannot record them till the time they are not materially certain, virtually certain. So then we will apply that variable share of profit based on contractual agreement shall be recognized and when become receivable. Variable share of profit based on past performance or is contingently dependent on decision of third party, etc., shall be recognized except to the extent of best estimates of amount recoverable with reasonable certainty based on future projection, established customary practices after allowing for a reasonable margin for uncertainties. And variable share of profit related to or fully dependent on future performance shall not be currently recognized irrespective of their probability of recoverability. So if we expect that in future there will be a profit and we will be having a future additional profit share, that will not be recognized today. I don't think we are having too many questions. So either it is, this is my pet sentence. A lot of you might have heard it earlier as well, that either it is too complicated or otherwise I'm too good. I'm explaining it so well that nobody puts a question. But we would highly appreciate if we receive some comments and questions on this one. Presentation and disclosure. In case of applying the off-balance sheet as accounting method of a working partner shall at a minimum make the following disclosure. So the summary of assets, liabilities, related movement, etc., total administrative and operational expenses that are charged, along with their description, the amount of profit and loss attributable to the investor, identifying variable incentive or tiered profits, and the basis applied by working partner for variable shares of profit, if such are material, the cumulative amount of contingent share of profit receivable. So if you have not recognized some part of profit receivable because it is contingent due to the requirements above, then we will have to disclose it. And disclosure of transfer of asset from to owned asset from the participatory venture. This is also important, that if we have transferred the assets, for the purpose of creating the Mudarba venture, there is a sale or transfer of asset, those shall be disclosed in line with the relevant FE standard. It need to be updated, Brother Majd, I think. Transfer of asset standard is updated. Am I right? So we'll create a reference to the new one only. Under the quasi-equity accounting approach, now this is the second approach. So in the working partner side, we have 3 approaches. On the investor side, we have 2 approaches. In the working partner, first approach is equivalent to investor does the proportionate consolidation, means that they book it on the pass-through approach, and the investee does a off-balance sheet approach. This is the first situation. The second situation, which will be the most common one, is that the investor will be doing a net investment method and investee will be having a quasi-equity method, the one that we are discussing. The third situation that only applies for the working partner situation is when there is a shared control, working partner also does the investor accounting as a net investment in venture approach. Okay. So now quasi-equity approach, in a nutshell, this quasi-equity approach is very similar to the bank's unrestricted investment account or the bank's quasi-equity approach. So the basic accounting is the same. So under the quasi-equity approach, the amount of cash received will be recorded, cash or in kind that will be recorded as the quasi-equity capital. And obviously, it will be appearing on the liability side, but it is quasi-equity. Then the initial recognition requirements are there, that it will be on the current carrying value of the underlying asset. So if the assets are transferred, so this will be shall be underlying asset and liability will be recognized initially on this basis. There can be transfer situations as well, and there can be in-kind asset situations as well, in which case situation there will be fair value adjustment. So the current carrying value of the such underlying asset and liability already owned by the working partner. So in that situation, you do not recognize and gain a loss on this situation. We will continue as of the same position. In case of contractually agreed value is being different, if the contractually agreed value, so I have already have a plant in my books, but if the contractually agreed value becomes different, so then contractually agreed value will apply. If there are investors' assets which are transferred in kind, then the value agreed for them for that purpose will be like fair value will be applied. Initial recognition in case of application of 39B, the difference now 39B is a situation where I have a asset plant appearing in my books at 100 million and the agreed value becomes either 80 million or 120 million. So what applies there? Like it's like a sale and lease back situation. It's not leasing, it's sale and mudarba back or sale or musharaka back. And we don't have used this term, but just to explain it, that it's like sale and having a participatory transaction. So what happens? This accounting we have kept slightly similar to what is the accounting in case of sale and leaseback. Not exactly the same, but more or less the approach is the same. So we are saying that any gain or loss not being an impairment loss shall be amortized by the working partner over the period of participative venture unless the participative venture does not have a fixed period of maturity, or if it is not committed or reasonably expected, the working partner will acquire full ownership of underlying asset of the participative venture either through gradual transfer of ownership, at the end of the term of participative venture. I think, Brother Maj, there is a space because of which this bracket close is going to the next line. Just extra space need to be corrected. In this case, such gain or loss shall be immediately recognized. So what we are saying, normal situation, any gain or loss will be amortized over a period of time, except for if the venture does not have a maturity. So you don't know on how much period you are going to amortize it. Okay. Or it is not reasonably expected that you will get back those assets. So if it is expected that I am selling these assets right now to the investor, but this is expected that I will get them back after the term, in that situation, the gain or loss will be amortized over a period of time, except for impairment loss. So because what happens that this loss can be a margin by the investor also. So the asset appearing at 100 million, but we contractually agreed to apply value of 80 million to the asset. Now, is this difference of 20 million an impairment loss, or is it, how I put it, or is it a margin for risk agreed between the parties? So if it is an impairment loss, it will be recognized immediately. But if it is a gain or it's a loss not being an impairment loss, in both situations, since it is expected that the asset will be purchased back by me, there is no point in recognizing that today. Rather, I will have to keep it like, you know, like I'll have to keep it as a separate account and amortize it over a period of time. So eventually, I do not recognize a gain and recognize a loss in future. Rather, I just eliminate that risk, gain or loss for the time being, except for if we did the fair valuation of the plant and the fair valuation actually came less than that, or other evidence suggests that there is an impairment situation to that, and that is the reason that we are agreeing to 80 million. So it's not a risk margin to agree on 80 million, but it's an impairment loss for that we are agreeing on 80 million. In that situation, it's an impairment that I need to recognize immediately. Any questions? I think no questions. We have Brother Latifulian's questions related to upcoming paragraphs, so we'll come to that. Now, subsequent measurement, subsequent to initial recognition, and working partners shall follow normal accounting policies. So you will be doing like proper accounting with respect to all of it. The investor share in profit shall be recognized at the end of each financial reporting period as an expense according to the contractual arrangements. This is similar to, like, you know, this is quite similar to what we do in case of Islamic banks. So the treatment for this mostly will remain similar to urea. Again, for losses, if they are determined, they will be recognized accordingly. Losses due to misconduct, etc., that we have addressed. There is one important thing: a provision shall be maintained for any contingent or conditional share of profit attributable to the working partner as per contractual terms in respect of any variable share of profit related to past performance, which is contingently reversible on a cumulative basis. For example, reversal in case of a future loss is contingently dependent on a decision of a third party. For example, a decision of the trustee at the maturity of the transaction. Out of such provision, an amount may be taken to the income if and only to the extent that there remains no material uncertainty based on justifiable future projection, established customary practices. Brother Mash, just see in the other places either we have used practice or practices. It should be consistent in different paragraph. I think it should be customary practices, okay, wherever we have used it. That such amount is no more payable. Then we have presentation and disclosure requirements about, like, some breakup of that and the administrative and operational expenses that are charged, amount of profit and profits, etc., including variable incentive or tiered profits, and the basis applied for variable share of profit, any contingency amount, the cumulative amount that is provision against contingent share of profit, so contingency and its movement to be disclosed, and any transfers of assets from owned asset to the participative venture assets, those should also be disclosed. There are additional considerations with regard to, like, some of the disclosures and requirements for FAS applicable on quasi-equity. That is right now FAS 27, but the new FAS 45 that will also be applicable. Specific considerations. Okay, we clarified it already. Just here we are having two types of accounting, but we already mentioned that the third type of accounting will be similar to the investor accounting. So we did not repeat it again. We just refer to the same paragraphs. Specific consideration. Perpetual participative venture. Certain participative venture, though in rare circumstances, may be perpetual in nature. That is, these are not subject to liquidation at a fixed maturity date, or these do not have a put option of redemption in the hand of the investor. In those situations, there is a rebuttable presumption that such participative ventures may qualify for accounting as equity under the requirement of relevant FAS and represented a separate class within equity. In such case, the working partner should follow the accounting requirements applicable to underlying assets and etc. under the quasi-equity accounting, and the investor shall follow the net investment in participative venture accounting approach as prescribed in paras to this. Brother Mike, I think there is just one thing to be clear. May qualify for accounting as equity instruments under the requirement of relevant FASs. Equity instruments. And we should mention equity instrument for the investor, for the investee, for the working partner, as equity instrument for the working partner and investment in equity instrument for the investor. Because this the 48 second line shows only for the working partner and does not show for the investor. But maybe we can use the term equity instrument here consistently. That can also be used. So maybe very slight improvement in wording here will be needed. Okay. Forms of transfer of control. Transfer of ownership from an investor to working partner or to the venture take place through transfer of control, entailing risk and reward incidental to ownership of such underlying asset under separate arrangement taking form of either of the following: sale undertaking by the investor or purchase undertaking by the working partner executable after the end of the participating venture term, or at times when a specific event triggers early liquidation of participating venture. That is such situation. That is normally what we call constant musharka mudarba. The second situation is gradual transfer of proportionate ownership. That is what we generally call as diminishing musharka. The third situation is partial redemption of equity through partial sale of proportionate ownership in form of ownership units based on mutual agreement before intended maturity. This is the third situation where we mutually agree to do that. Timing of transfer of control. So this paragraph 50 addresses that what would be the appropriate timing of recording of such transfers of controls. So this is these are the requirements related to that. I'm not going in detail for this one. then in case of recognition of transfer of control, complete or partial, there is some important points here. Under all forms of intended or mutually agreed transfer of control or proportion thereof from the investor to working partner, the transaction of transfer of control of underlying asset and liability or proportion thereof shall be recorded separately from the transaction of investment in participative venture and recognizing returns thereon in line with requirement of paragraph 50. The investors, irrespective of the accounting approach followed, should recognize the underlying asset or liabilities on proportion thereof from their brother Mike. Here or proportion thereof we are using in commas without bracket, and above paragraph 51 we are putting in bracket. I think we should be using commas here and the 51 also. Okay, 51 is using it at two places, in first line and the third line. So the investor will recognize from their book of account while recognizing a gain or loss on such transfer being difference between the carrying value and the fair value of the consideration received or receivable. The working partner at the time of partial acquisition of control shall apply the respective accounting treatment from the following corresponding to the accounting approach being followed. In case of applying quasi-equity approach, shall record a reduction from the amount of quasi-equity reflected in financial statement attributable to the investor while recognizing a gain or loss of any on such transfer being the difference between the carrying value of such proportion of quasi-equity and fair value of the consideration paid or payable. Mostly there will be no gain or loss, but yes, there can be situations where there is a gain or loss. Gain or loss may appear in case of early settlement. Gain or loss may be applicable when the more puristic approach of Sharia is followed, where the transactions take place at fair value. In case of applying the net investment in participative venture approach, shall increase the amount reflected at net investment in respective participative venture at cost of such additionally acquired units. Recognition, there is a rebuttable presumption that a working partner applying the off-balance sheet accounting approach may not experience partial transfers of control from the investor except that for extraordinary circumstances. In such an event, the working partner shall reassess the suitability of accounting approach and shall preferably change the same to either of the following as considered appropriate: quasi-equity accounting approach or net investment in participative venture approach. So the point is that, Brother Mash, that is just recheck the point that I raised in the table, you know, that we'll have to make sure that these are aligned together. Do we have any other comments? Okay, there is one more comment coming up. I think Brother Latif's point was on para 57, so we are just reaching there. Brother Najibullah Faizi has raised a question: who can be the participatory ventures? Brother Najibullah Faizi, the participatory venture is the virtual partnership that is created. So all Musharaka, Mudarba partnerships that are created, they all become participatory venture. So the participatory venture related accounting also is required to be done by this standard. I'm not sure, because your question is very brief, so I'm not sure whether I'm able to answer it pretty clearly. So if you want to have further clarification, please feel free to explain your question further. If my question is not sufficient, in that situation, please just suggest it. Thank you very much. So just again, coming back to this, that in case of working partner at the time of complete acquisition of control. So when the transfer completes and the whole venture is liquidated, it shall apply the respective accounting treatment from the following corresponding to the accounting approach being followed. In case of applying off-balance sheet, shall recognize all underlying assets and liabilities in its books of account while recognizing a gain or loss on such transaction being the difference between the fair value of the underlying asset recognized in books of account. So what we are saying, if you were using the pass-through approach, so it means for me, it was an off-balance sheet asset. I'm the working partner. For me, it was off-balance sheet asset under management. Today, the venture is completed. Once the venture is completed, I acquired the asset. So these assets can be sold to the market. It's okay, I just received the cash. But if I acquire the asset, in case of acquisition of asset, I apply the fair value of assets and liabilities as of that date. Brother Mash, here just a question whether we can apply fair value of liabilities, or we should say net with liabilities, because liability fair value should not be applied normally by Sharia. So just keep in mind, wherever we have used the term fair value for underlying assets and liabilities, we need to see that some liabilities which are monetary liabilities may not be allowed to be fair valued. So we need to correct this wording at several places in this standard, or to provide an explanation somewhere. the consideration paid becomes like, so the difference of the consideration and the fair value becomes a gain or loss. In case of applying the quasi-equity accounting approach, shall recognize the amount of quasi-equity reflected in financial statement attributable to the investor while recognizing a gain or loss on recognition between the difference between the carrying value of quasi-equity and the consideration paid or payable. So quasi-equity becomes zero, and either you pay cash or you create a liability, because there will be no further return on that, so it will be interest-free liability. But if there is a difference between the two at that point of time, there will be a gain or loss that you recognize immediately. In case of applying net investment in participative venture approach, shall recognize net investment in the participative venture and recognize all underlying assets or liabilities in books of account. They will come to my assets and my liabilities according to that. And if obviously there is a gain or loss in that situation, that will be recognized according to the same formula. There is another unique issue, which is onerous commitment. A commitment to transfer ownership or proportion thereof from an investor to the working partner at a promised value or at fair value at times may be different from the carrying value of the underlying asset or underlying net asset or a participative venture, may turn onerous on either party if it results in an expected loss on such redemption or gradual transfer of ownership. So I have assets in my book at 100, but it is expected that when I settle it, it will be settled at 80, which means I will be having a loss of 20 at that point of time. What we are saying here is that this becomes an onerous commitment situation. So our standard, other standards also address the onerous situation, particularly FAS 30. So you will have to record a loss situation in that situation according to that. Here, I think we had the comment from Brother Latif on paragraph 57. Does the requirement apply to other type of guarantees given by the working partner, for example, for performance legal case? Brother Latif, you have raised an excellent point here. So yes, if there is a Sharia compliant guarantee, that is also subject to the onerous situation. Brother Majd, I think we need to consider either we add it or clarify this point somewhere else. Brother Latif Oilan, thank you very much again. It is an excellent comment, highly appreciated. Then, Brother Latif, you have other question also. Would a promissory note qualify as an instrument under this exposure draft? I would suggest that my answer quickly would be no. What happens if the venture does not prepare financial statements? We believe that financial statements are mandatory as per this standard. Otherwise, at least you need to do estimation of profit and losses. So even if not proper financial statement, but at least minimum set of financial accounting need to be done. Like, for example, in case of Islamic banks, we do not prepare full financial statements for the investment accounts, but at least for each investment pool, we create a working. So at least that working would be needed, although this standard requires that a minimum level of financial reporting is done. So for us, it is a non-compliance of the requirement, but still you need to apply. But we said that if full information is not available, that would be there. So in those situations where you don't have the information, you cannot recognize the gains. And let me repeat it. If you don't have the financial report information available, so for example, you created a musharaka with me. I do not provide you financial statement, financial information. You cannot continue accruing returns. You have to wait, and even if I don't provide it and you don't want to push me for that, then you will have to wait for recognizing any return forever. Till the time I don't provide you the financial working of how much profit and loss was there for the venture. Would it become an audit issue? Yes, for sure, it's an audit issue. Other drafting comments, paragraph 18, would it be possible to replace a clubbed paragraph 18, sorry, I go back to paragraph 18 now because you have one comment on para 30. That is memorandum of information. Is it possible to further explain this term? It's not memorandum of information, it is memorandum information. So we are saying that it's not a full set of okay, let's try to find a better wording. It's understood that, okay, thank you very much, Brother Latif. Because for us, some of the accountants, memorandum information is an understood term, that it is not part of the main double entry accounting, but it is an accounting information that is provided separately. But maybe we can find a better word, or we can just remove memorandum here. We'll see and we'll discuss it with the working group. Thank you very much again. Again, you have raised some very good points and good issues. Paragraph 18, you have another comment about would it be possible to replace the word club? These are to be clubbed. I think we should say these are to be incorporated. Personally, I would say that incorporated or added. Incorporated or added. So we'll discuss it with the working group and the board. Thank you very much again, Brother Latif. You have raised some very good points. Almost all points were very good and added value to our today's discussion. Allah bless you. So I think now we have done with your comments. Okay, so we were at, now we have a bit limited time. So I think we are reaching like, for, yes, Brother Mahesh.
There is a question from Mukhab Ismail. It is in the chat box. مشاركة and مضاربة contracts used to think of participatory venture instrument through the pricing of each single item of the inputs. It is and the process which were the capital of the transaction according to their percentages in the pool. The parties were the outputs owners share the revenue, the profit, the risk. It can be used for agriculture, industry, services, for short, medium, and long-term partnership, for private, takaful, government, etc. The topic is available and I can share it. So maybe he's proposing or...
Thank you very much. We would love to have your comments. You can share with us at accounting@aofi.com, inshallah. Allah bless you. We'll highly appreciate it. We also invite you to write for our journal, Joifa, Journal of Islamic Finance Accountancy. We'll highly appreciate that if you can write something for our journal as well. Thank you very much and highly appreciate it. Okay, then I think we have owner's situation and then gradual transfer of ownership. There might be some gains or losses on the gradual transfer, so that we have asked for the accounting according to that. Variable equity participatory venture, that is running musharaka sort of thing, that is also addressed here, and that will normally be according to the quasi-equity accounting. And we also referred that quasi-equity accounting as per FAS 45 should also be followed as far as practicable. We have kept the option of discussion on risk, option of risk reserves to be accounted for in line with the AOFI FAS 35 on property equalization reserve and investment risk reserve. So these can be included for sure. We have a comment from Brother Amruddin Hassan. In less developed countries, like there is a lack of trust between capital provider and investment manager. It means that Islamic Bank provide capital for participatory investment. There is a chance the investment company may hide the real profit, real cash flows, etc. to avoid what should we do to Islamic Bank to know about real profit and financial. I think, Brother Amruddin, you raised the right point. It is based on the initial discussion actually today. Before actually starting discussion on the standard, we had long discussion on these aspects. Our argument and our answer was three things: have proper governance, have proper financial reporting in line with this standard, and have exit strategies. That is the solution to your question. Again, have appropriate financial reporting, have appropriate governance and controls, and have exit strategies. Thank you very much, Brother Amruddin. I think we are trying, by way of having this standard, we are trying to answer these issues. Now for the participatory venture. So since the time is limited, it's a simple accounting, very simplistic accounting. We said that for the participatory venture itself, the partnership itself, you need to prepare a summarized set of financial statements. You need to follow, prepare a very summarized report of financial position, very summarized report of income and expenses, and so we are asking summarized financial information. We are not asking it summarized financial statements. So we are saying that a summarized form of financial report is enough. Financial position that is equivalent to balance sheet and report of income and expenses, and explanatory material and some notes might be helpful. There is one important point that at times the participatory venture can follow the accounting practices and policies which are followed by the investee or the working partner. But in some situations, it can be agreed with between the partners that they follow a specific set of accounting policies. For example, even the depreciation rate applied may be different according to mutual agreement. Even the accounting policies for some of the items may be more prudent. So considering these things, it can be either the accounting policies of the working partner, or it can be mutually agreed. Then I think this is actually because this may impact the determination of profit and loss. So we have discussed this aspect in these paragraphs here. And then general accounting considerations are there that you need to follow generally by the initial recognition and measurement of liabilities, quasi-equity, equity, etc., and recognition of revenues, etc., shall be in accordance with the AOFI phases. And obviously, where the AOFI phases are silent, you have to follow the IFRS or other locally applicable accounting and generally accepted accounting principles. Then I think that these points are like a bit more detailed, so we don't need to go into this. Presentation and disclosure, there are some minimum disclosure requirements, etc., with regard to the things, making sure that appropriate information is available. And I would like to re-emphasize, Brother Amruddin, that this is all we are asking, that we should have appropriate information available. We are making it as a mandatory requirement, but yes, there can be a challenge. The challenge is this standard is applied by, for example, Central Bank of Bahrain. But what happens if the investment is done in a corporate entity like ELBA? ELBA does not follow AOFI standards. So this can be an argument that this is that ELBA is not subject to requirements of this. Our suggestion would be that first regulators who are attending today should be considering adopting Islamic AOFI, Islamic Finance Accounting Standards, as applicable on the Islamic financial institutions, but also on Islamic finance transactions, because we develop it for Islamic finance transactions as well. Secondly, it is very important governance requirement that having this information available should be part of the contract. So every contract should provide, or every Musharaka Mudaraba contract, this is advice personally by me, and I would say that it's a general advice by AOFI. It may not be written as a requirement here, but it would be very good practice that all Musharaka and Mudaraba agreements should include an appendix in line with the requirement of this participatory venture accounting requirement that we have here. Brother Majd, I think we had some discussion on this thing, so we should write a base of conclusion on that as well, that it is very important that the Musharaka agreements in the situation where the counterparty does not follow AOFI, they should still be required by virtue of the agreement that this is there. So at least we can write it as a recommendation in the base of conclusion. The idea is that we want to make it applicable by 1 January 2026. Our target was to finalize it within 2024, but I think that we will be able to finalize it in first quarter or first half of 2025 now. So maybe the effective date need to be increased. We would love to have some comments from you with regard to the effective date. Do you feel that it would be practicable? But normally our policy is that from the date of issuing the final standard, we give at least 1 year. So in that situation, we might need to change it to 2027. Sister Saira and Brother Majd, please make a note for the working group about the effective date as well. And we would love to have some comments from the participants here as well. So with that, there are some transitional provision about allowing the old accounting for on a prospective basis for transaction on or after. So what happens that old accounting for all the standard that all the transactions that were already there, you can follow the old accounting policies. This standard will supersede phase 3 and phase 4. And with that, I would like to conclude and would like to thank you all. I don't see any questions raised at this point of time, and we have just 3-4 minutes left. So let's get a very quick opportunity. We have 3-4 minutes left. So if anybody has a comment, they can put in Q&A tab or they can raise their hands, and we can allow in remaining 3-4 minutes to respond. Anybody want to make a comment by opening up their mic, please raise their hand. Or if anybody want to raise a question, they put it in the Q&A tab. Okay, Brother Amruddin Hassan again raised a question in the Q&A tab. Participation as participatory sukuk through Islamic bank and foreign market through an agent or wakil contract. The main issue is the wakil is hide. It's the real asset behind the musharik sukuk. Brother Amruddin, our answer to that is that this standard requires less detailed accounting. But you should read our financial accounting standard number 34. Our financial accounting standard number 34 is about financial reporting to the sukuk holder. So we require that all sukuk entities should provide appropriate information to the sukuk holders and possible investors about what are the underlying assets, what are the actual returns of that, etc. So phase 34 addresses the answer that you are asking for. Only thing is, we are doing our part here by developing the standards. It's the responsibility of the regulators and the institutions to follow our standards and implement them in proper proper approach through a proper approach. Brother Amruddin, answer is already available by IOFI. And we have a very good standard on governance of Sukuk, which is governance standard number 12, which requires some information, and even the Sukuk standard, Sharia standard exposure draft 62 also talk about accounting and these things. So from that perspective, considering that AOFI is doing its task, now it is the responsibility of the regulators and the market participants to get these things implemented. Thank you very much, brother, for your kind comment. Highly appreciated. We have another comment from brother Najibullah Faizi. What about operation lease, if it is off balance sheet or not? According to new FAS 32, operation and lease or any ijara, no, it's not only about operation lease. We do not distinguish it in that way like conventional. But for us, now, according to FAS, it was FAS 8, I think, earlier. It was off balance sheet, but according to FAS 32, which is now already in effect for last 2 years, FAS 32 requires that the right of use asset should be recognized. This accounting is closer to IFRS 15 accounting. Although the lessor side accounting is still slightly different from IFRS 16. So from that perspective, I would suggest you to read FAS 32, please. The answer is already very well defined in FAS 32. Thank you again. And with that, if we don't have any other question or raised hand, I hand it over back to my brother Maj to close the meeting.
Thank you, brother.
Thank you, everybody.
Thank you too. Ladies and gentlemen, distinguished participants, dear brothers and sisters, with that, and as we have reached the end of today's public hearing session on the newly issued exposure draft of Financial Accounting Standard on Participatory Ventures, I would like to thank Mr. Omar Mustafa Ansari, IOFI Secretary General, for the insightful and thorough presentation of the exposure draft and the answers provided to the participants' questions and comments in today's public hearing session. We would like also to extend heartfelt thanks to all our valued participants from across the Islamic finance industry and beyond for having taken part in today's public hearing on the exposure draft of this standard, and for all the regional banking associations that provided their kind support to this session. Your comments and suggestions are essential for IOFI in improving and fine-tuning the exposure draft for finalization by the board, IOFI Accounting Board for final issuance. All relevant comments and suggestions will be compiled and presented to the respective working group to consider and make the changes it deems appropriate and necessary to the exposure draft. Thank you again. Thank you all for your participation today, and see you in the upcoming future public hearings on IOFI Financial Accounting Standards. Wassalamu alaikum wa rahmatullahi wa barakatuh.